I started in real estate, I was like, what the heck is cash flow? What is net profit? And what should I be making in my rentals? In this video, we'll be covering 5 critical steps: how to finance your first rental, what the heck is cash flow, how to calculate cash flow, why MTRs are so profitable, and the risk on MTRs with strategies to manage them. Welcome back to day 5 of our series, Building a Successful MTR Business. My name is Michelle, and I'm here to help you through your real estate journey by providing you my story that will hopefully inspire you to take the leap of faith and build your legacy while impacting others. Today, we're going to be covering a big one. Something is like one of my favorites: financial preparation and cash flow management. So let's dive in how to set up your finances so you are ready for anything. But a disclaimer first. All advice shared today is based on my experience, as I am not an attorney, financial advisor, or certified to give financial advice. Make sure you consult with a professional to find the best strategy for your situation. All right, now that that's all out of the way, let's get into my story and the juicy stuff. When I started in real estate, I knew of cash flow, but I didn't really know about real estate cash flow or the difference between a hard money lender that says he's a private money lender. I honestly think it wasn't until about my second property did I start to realize, when I purchased the property with hard money lending, that I had to refinance it and pay all these junk fees, not once, but twice. So let's talk about how to finance your first rental property. Let's start with financing options for your first rental property. Finding the way to fund your investment is crucial, and there are several options to consider. So, traditional mortgages. With a great credit score and some savings, you can have a standard mortgage as little as 5%, and that can be a solid choice for you. Those would be like the government-backed loans like FHA, VA, or conventional loan. I personally have never used this approach for my investment properties, but these are options that I do know other investors use. Another option is HELOC. If you already own a home, using a home equity line of credit, or HELOC, can be a smart way to access funds without selling off assets. This is an approach that I highly recommend if you have like a ton of equity in your home and you want to leverage it. I actually had a friend of mine that she had been living in her home for almost 20 years, and she was outgrowing her home and she wanted to get a new property. So what she thought she was going to do is sell her house and then go and get another property. When I told her, why do that when you can actually leverage the equity? And when I say a lot of equity, she had like 200 and something thousand. So why don't you leverage the equity, get that other home, keep this home in your family and rent it because you have such a low interest rate on it. And then also you'll be able to have 2 properties now instead of 1. So that's something that we can talk about later at a different time, but that is an option you can use, is a home equity line of credit. And by leveraging your current property and just keep going, I can show you kind of the way that works. So another way, which is the way I did for a while, was use hard money to secure the asset, then refinance it into a DSCR loan after. So that's a debt service credit ratio. What that is basically you can get the loan in an LLC. It doesn't go on your personal credit. And that's how I like to purchase properties, because it's a way of asset protection. But I actually changed that model in late 2023 because the interest rates were skyrocketing and it was like eating into my cash flow, which we'll cover later what cash flow is. My favorite and current strategy is subject to and raising private money. So subject to is subject to financing. Basically, the seller is the bank in this situation. So sub 2 allows you to take over a seller's existing mortgage payments, making it an excellent option if you want to go in with low upfront funds and don't qualify for traditional financing. You could also get a low interest rate, which increases your cash flow and allows you to keep the loan in place. And it doesn't have to be on your credit or take 60 days to close. So most of the times, this also helps the individuals get out of a bad situation while you get a great opportunity and you are able to keep a very low interest rate. So this has been around for quite some time, and I wish I knew about it when I first started, but I was learning so many different strategies, and we actually have picked up quite a few subject twos, anywhere from like a 2.75 interest rate all the way to about a 4% interest rate. It really does help you with that cash flow. And also, you don't have to worry about getting your credit pulled and going through all of that crazy stuff. It's very nerve-wracking when know that you could get approved, but also kind of afraid if you will or not, and what the dang interest rate. Now, when we purchase any of these homes, we are always using a private money lender now to bridge the gap, maybe pay for furniture cost, and also that safety net during the ramp up time. Now, big disclaimer, don't get tricked like I did in the beginning when a hard money lender says they are private money lenders. The easiest way to determine is asking them, is it their personal money, or having them send you an email. And if it has an actual company at the end of it, then they're probably not a true private money lender. Or I ask, are you wanting origination points? Origination points are points that they want for a loan. Typically, private money lenders won't ask for that. So if they answer any of those, then they're not a true private money lender. So a true private money lender are like friends, family, and other seasoned investors who may meet through networking. So be sure when you do have that transaction, you have set clear and professional agreements. If you want to learn a little bit more about that, I can do a session on just how to raise private money and also what to protect you as well as the private money lender. Put some comments below and I'd be more than happy to. That's kind of one of my favorite things to talk about, is how we are able to raise income with little to no money out of pocket. So you can use a combination of all of these options together. And honestly, I would just explore what options best suits your needs. For example, I have a friend that has a great paying W-2 job and she runs short-term rentals. She only gets government-backed loans and she puts 5% down to secure the asset. It works for her and she is on her 5th or 6th property now. So there is no right or wrong answer. Just do your research and know what your tolerance level is and what works best for you. All right, so let's move on. Step 2, what is a good cash flow for a rental property? Well, let's talk about cash flow benchmarks. Positive cash flow is essential. It's what makes an investment worthwhile. So typically a good cash flow margin is around 8 to 12% of the monthly rent. So if you are renting a property at $2,500 a month and you at least make $200 to $300 in positive cash flow each month to cover unforeseen expenses and keep your finances healthy, this is more for a long-term strategy. That actually is good. So when I first heard this, my jaw just dropped because I was like, what the heck am I going to live off of, or how am I going to live off of $200 to $300 a month off of one property and all the things that I have to put into that? So this is kind of why I did choose a midterm rental strategy. It generates more cash flow than that. And that's why midterm rentals is kind of the reason why I decided to go. So let's answer the question. What is a good cash flow for a rental property? In this current market, anything that isn't negative, I'm just kidding. My personal benchmark is around $800 to $1,000 a month net cash flow. Of course, there are some months that we earn a lot more, but this is what my goal is set for in our current market. Now, every market is different, so be sure to research your market to know what that is in your area. And if you don't know how to research it, just stay tuned for future videos because we will take a deep dive into that as well. So what is cash flow? Cash flow is after all expenses, and I mean all expenses like toiletries, non-consumables, paying the landscaper, paying for your mortgage, all expenses. For example, if you rent your property for $2,500 a month and your total monthly expenses equal $2,200, you're left with $300, which is your cash flow. This is just extra profit. It's a cushion that keeps your business running smoothly. This leads us to the next step, step 3. Now, how do you calculate cash flow for a rental property? Let's go through a simple cash flow calculation to help you see what this looks like for a real property. All right. So number 1, calculate the total income. Start with your monthly rental income and any extra fees. Number 2, subtract fixed expenses. This includes your mortgage payment, your property taxes, and your insurance. So number 3, subtract variable expenses. These are costs like maintenance, utilities, and management fees. I always use a 10% benchmark of the total monthly income. So for example, if your income is $2,500, I would put aside $250 for additional, we call it kind of the treasure chest. So number 4, the result is your cash flow. This amount shows how much you're actually taking home after expenses. So let me give you another example. Let's say your MTR brings you in $4,500 monthly with mortgage, utilities, management fees, and maintenance adding up to $2,900. Then your cash flow would be $1,600, a strong figure that helps you reinvest or save. So think of cash flow as the fuel that keeps your car moving forward. Even with a beautiful car, without fuel, you won't get any. So why are MTRs profitable? So why do MTRs make sense for cash flow? Well, MTRs cater to a unique market, like traveling professionals and remote workers. This demand means you can charge a premium for fully furnished, flexible rentals, leading to better cash flow than long-term leases. For instance, an MTR in a top location might be able to provide 20 to 30% more than an LTR, a long-term rental. So a client of mine had a property near a tech hub, and it was a long term, and it would have made around $1,400 a month, but as an MTR, she was making $2,200. And this was for a small studio. That's kind of not where our prices are right now, but that was for a small studio. And so that was a massive difference in her cash flow. A great example why MTRs are kind of a smart choice, in my opinion. So think about a property or market you're interested in. So look up the long-term rental rate and compare it to the MTR rates. So drop a comment with what you find below. How you can do this is you can find the MTR rates on Zillow.com or Furnish Finders and see if you see any furnished rentals and compare those to the unfurnished rentals in the market. And then you can see the difference in what you can get. As I mentioned, the rule of thumb for an LTR in any market is usually you're making about $200 to $300 a month. So with all this data, you could probably figure out what cash flow would. So lastly, let's talk about the risks of MTRs because every investment has some challenges. Here are a few to keep in mind. Vacancy rates. MTRs may have gaps between tenants. To handle this, you want to have 1 to 2 months of vacancy each year to protect your cash flow. Though we don't have that many vacancies now, like we did at the beginning, we, due to fine tuning in our marketing, the national average is around 70%, but in the San Antonio market, it's about 50%. So know your market. So the second thing is higher maintenance costs. Because MTRs are fully furnished and experience turnover, maintenance costs can be higher. Set aside a reserve for regular upkeep and stay on top of your repairs. One of the other things that I highly suggest as well with MTRs is doing a bi-weekly cleaning or a monthly cleaning, bare minimum, because what happens is if you have these properties rented out for 3 months at a time, then it's a lot of wear and tear on your property, or you're not there to know exactly what they're doing. And it's treated a little bit different than an LTR. And so we implemented that a couple of years back, that our cleaners are kind of our eyes and ears out in the market and helping us protect our homes. And a lot of cleaners in this industry know that. And so they will go and they'll go do bi-weekly cleanings or refresh cleanings during their stay. And it really helps the upkeep. It also helps us keep our maintenance costs down. So you might think that you're going to pay a little bit more for cleaning, but it actually helps out in the long run. And then we can kind of see exactly what's going on with our property. We recently just had that. Someone's been staying with us for 2 months, and we had to go and look at the property, and it was not in very good shape. So we just recently wrote a violation for that, and basically going to go out there again in 1 week. And if they don't correct it, then unfortunately we are going to have to contact the insurance company and let them know that the property's not in livable condition, and they'll probably have to move out. So kind of learn from my mistakes and know that you want to make sure that you're doing those cleanings to help you with lowering that maintenance costs. So market fluctuations. Demands for MTRs can shift with the economy. So having a flexible pricing strategy helps you adjust and maintain occupancy, even during slow days. So we personally have a locked in rate for some of our rentals, which means that we won't adjust the price due to seasonality because we want to maintain the same rate all year round, which those properties outperform my hybrid properties. And when I say hybrid, so I have some properties that are still in short-term rental, the ones that have the pool and that are located closer to the downtown area. But what we do is we just have that locked in rate, and we have found in our market that works best, and that keeps our profit. Always have a solid emergency fund of 3 to 6 months of expenses. Automated tools like Stessa or QuickBooks can help you track cash flow and stay prepared for surprises. So remember, building a successful MTR business isn't just about acquiring the property. It's about being financially prepared and managing cash flow wisely. These steps set you up for a long-term success and help you reach your goals. Let me know in the comments what part of today's video was most helpful, and if you want me to take one of the topics or a couple of them and break it down even further on the strategy that I use to build my portfolio. And if you haven't already, hit that subscribe button. I've got so much more to share and to help you build a profitable. On our next episode of this series, we're going to dive even deeper into why midterm rentals are such a profitable strategy and how they stack up against short-term and long-term rentals. So you don't want to miss it. Thank you so much for joining me today, and I look forward to continuing to share my knowledge with you and hope that I can encourage you to keep building wealth.